Good evening, everybody. Welcome back to Strongman Personal Finance. We got a sponsored video. Oh, the check, it deposited into my bank. Oh, and it felt so good. Anyway, in this sponsored video, which, by the way, you can as well. You send me $50 and I'll make you a personalized video, whatever you want. Anyway, Cloudflare is the subject of the sponsored video. What is Cloudflare? Well, it's a cloud services provider that delivers a range of services to business worldwide. The company provides an integrated cloud-based security system to secure a range combination of platforms. So basically, you're a big corporation or even like a smaller business and you need, security. This is my crappy knowledge of technology and IT. You need cloud-based security to protect your system from hackers and clowns and whatever. You could potentially turn to Cloudflare to help protect your company from financial ruin because there are a lot of disgusting, nasty hackers out there. Now, the first thing you'll notice about this company is that it's unprofitable. That is always the first thing I look at. Is this massively unprofitable share diluting trash, or is this the future, bro? I see negative net income. Now, when you see that, that doesn't always mean that the company is consistently unprofitable. It could have been one bad quarter that disrupted the last trailing 12 months of earnings. But it's an indicator that you should definitely look into that, okay? So it's an unprofitable company. It's got a market cap of $21 billion on $1.21 billion of revenue. Holy crap. That's a price to sales of probably a little bit under 20. Holy freaking crap, this thing is richly valued. Now here's what I think about stocks like this, okay? Stocks that are very richly valued like that, they're either in a clown bubble or they're growing so rapidly and they have such bright futures that the valuation is justified. Right now, the market is very positive about Cloudflare's future, okay? Why? Because that price to sales on an unprofitable company is pretty freaking nuts, and we're going to see why in a second. So if we look at the stunk price, okay, over the past month, it's up 8.91%. Over the past year, it's up 37%. Over the past 5 years, it's up a healthy 329%, and it looks like this went through a massive, insane clown rally during the clown market. This stock went up to $211. It's now $64. Now, if you're one of those people that just loves high-growth companies like this, which it is, you'd probably be buying in here because growth just goes on forever, right? Well, people that bought in around here got absolutely annihilated. Even people that bought in right when the clown market started in late 2022, well, it really started in March, but late 2022 is when it looks like things started really taking off for this company. You still would be down 15-20%, okay? So you got to be really careful with stocks like this. This is one of those growth stocks, quote unquote, that can get absolutely nuclear obliterated if growth suddenly slows down. And it happens all the time, and you honestly can't predict it. Just my personal opinion, okay? So it doesn't have a PE ratio. Obviously, it's not profitable. It's got a beta. It's less volatile than the market. That's interesting, okay? And they just had earnings on November 2nd, 2023, which we'll go look at those in a second. Now, let's go ahead and look at some of the metrics. So revenue is basically going up at a 45-degree angle. That is very strong, powerful revenue growth. Will that continue? I have no idea. That's the risk you take. Maybe it does continue. Maybe it grows faster than the market's expecting and you make a bunch of money on the stock. Or maybe it suddenly underperforms or you have some kind of bad guidance in one earnings session and the stock can plunge 40%. Okay, I've seen it happen too many times. If we look at gross margin, it's very strong. 75% gross margins. I have zero complaints about that. Operating margin is negative. I'm guessing because of stock-based compensation, and you'll see why in a second. Profit margin is also negative. So when you factor in the holistic profits with the accrual basis of accounting, this is a unprofitable money-losing company, like I said, because of stock-based compensation. Every time I see these tech companies, these cloud-based tech, it's the future bro companies, they are always either barely profitable on the accrual basis of accounting or slightly profitable, but they have strong free cash flow. Why is that? Very simply, it's because the stock-based compensation expense is a non-cash expense that shows up here in this profit, but doesn't show up here because it's quote-unquote a non-cash expense. And really, the company gets money because they give the employees stock options. the employee exercises the stock options, and the employee pays the company in order to buy the stock. I mean, there are costs, trust me, because a lot of the times what companies will do is they'll give out stock options. The employees will buy the stock, and then the company will go in the open market and buy stock back. So really, the company is in a way losing money. But that's kind of how stock-based compensation works. But it dilutes the current shareholder you. Now we can see shares have, well, in the past, it looks like that was probably when it went public. You can see those crazy changes in shares. But they're still growing shares about 2% year over year. And if the stock price goes up and employees really start exercising their stock options, that could go up a lot more, okay? And then you as the owner get diluted. But the dilution is not outstripping the revenue growth, not in the slightest, okay? The balance sheet, we're going to save that for the actual financial report. Cash flow statement. Very consistent and growing operating cash flow, at least since early 2022. Since early 2022, operating cash flow, which is from the core business, has been going up generally. It's been trending up, okay? Stock-based compensation is also trending up. Now you can see there's a difference here. You have negative net income, but positive operating cash flow. And then you see an add back for stock-based compensation. That's why they're unprofitable, okay? That's the only reason they're unprofitable. Even with depreciation and amortization, well, but they would still be unprofitable if they didn't have stock-based compensation. But stock-based compensation is a big part of why they're not profitable on the accrual basis of accounting. Right? Capital expenditures, they've basically stayed the same, at least over the last year. Acquisitions, looks like they did one back in early 2022. Changes in investments, that's not atypical. Share issuance, we see positive cash flows from share issuance. That means employees are exercising stock options, okay? Or they're issuing shares, one of the two. Debt paid, looks like they took out some debt. We'll see on the balance sheet back in 2021. And they've paid a little of it off, okay? Ratios. Okay, my math is slightly off. I did it in my head. Price to sales of 18. That's still insanely expensive. And look where it was during the clown market. 60? What? That's insane. Price to free cash flow of 210. So you're paying $210 for $1 of trailing free cash flow. That means there's a lot of growth priced in. Price to operating cash flow. You're paying $87 for $1 of operating cash flow. It's going down, but guess what? That's still very, very pricey, okay? Quick ratio is, okay, yeah, this company is going to be fine in the short term. The quick ratio is a measure of how much cash and liquid assets they have, basically cash, receivables, and marketable securities versus short-term debts. They're going to be able to pay their bills, okay? It's been trending down. The quick ratio has been trending down, but 3.72 is a very strong quick ratio. So I think their balance sheet is probably going to be pretty solid, okay? So we know it's a little tech company, web security, and I've seen this company before. Like I'll go and log into a game or something, or I'll go to a secret website I can't disclose to you, and it'll be like Cloudflare, and then you have to click the button, and it basically verifies you're a human. So this software is used by smaller businesses and a lot of big businesses to protect themselves from cyber attacks, bots, stuff like that. Okay. So that's the overview of the financials. A very richly valued stock, but with some pretty strong margins and pretty strong growth, which is unprofitable on the accrual basis of accounting, partially because of stock-based compensation, but also because of depreciation, amortization, all that stuff. Okay, so let's go ahead and look at the balance sheet. So this is the balance sheet out of September 30th, 2023 versus December 31st, 2022. Cash has gone down pretty significantly, but they have $1.4 billion of available for sale securities. Now, available for sale securities are like this weird accounting classification. It's kind of a middle ground between investments. Like let's say you invest in debt or something, like another company's debt, or you buy treasuries. And so those are trading securities when you have the intention of just holding them for a little bit and then selling them off. Held to maturity securities are basically bonds or whatever that you intend to hold forever until they mature, until the bond matures or whatever, and you get the principal back. That's basically what held to maturity is. Available for sale is kind of like this middle ground where it's like, yeah, I'm probably going to hold these for a while and blah, 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 blah. It's important because the accounting for available for sale securities skips the income statement and goes straight to the balance sheet. And the account for that is called accumulated other comprehensive loss, which we can see right here. They may have actually made money from those available for sale securities. But any fluctuations in value in this are generally going to show up or be counted for down here, but they're not going to show up on the profit and loss. This is very important because if you go look at a bank and they have a lot of available for sale securities, you're not going to see the fluctuations and changes on the income statement. You're only going to see it here and on the statement of comprehensive income. So you got to be really careful because go look what happened to Silicon Valley Bank, okay? So available for sale, they have a ton of those. Let's see. Accounts receivables up, which has grown with their sales. That makes sense. Contract assets, that's, up a little bit. Restricted cash is down pretty significantly. I wonder what they did with that. And prepaids is basically the same. So they have 1.8 billion of current assets, mostly cash, cash equivalents, and available for sale securities. Very, very powerful balance sheet, at least so far. Current liabilities are only 477 million. Total liabilities are 1.8. So they can almost take their cash and basically pay off all of their debts. All of their debts. Now, the one thing I did notice is that for long-term debts, they have these senior convertible notes. They have 1.2 billion of debt, which it's not a huge amount, and they could theoretically pay it off with their cash on their balance sheet and available for sale securities. But it's a lot of debt, and they really don't have that many long-term assets. We have property, plant, equipment, $309 million. Goodwill from acquisitions, no change there. Intangible assets, leases. These are lease assets. Basically, you sign a lease, you got to put it on your balance sheet as an asset and a liability. But overall, they have a lot of long-term debt sitting there for not many long-term assets, especially tangible long-term assets. So it's a little interesting why they had to do that. I guess they just weren't cash flow positive, or maybe they used it to do an acquisition or something. But that's the only slightly concerning thing I see on there, but I don't even know when this is going to mature, and they are cash flow positive, and they have a war chest, basically. So they're probably going to be okay. All right. Let's look at their equity. So common stock, they've been issuing common stock. We know because that's been going up. I guess they have two classes of common stock, Class A and Class B. Additional paid-in capital has gone up, which is probably from stock options and from share issuance. And accumulated deficit has gone up. What does that mean? That means they've lost almost a cumulative total of $1 billion on the accrual basis of accounting since inception. $1 billion of GAAP losses. Okay, you take with that what you will. So just diving into the income statement a little bit more, they have a powerful income statement. So they grew their revenue pretty significantly. I did notice that sales and marketing almost grew by 30-40%, which is, it's probably they probably grew a little bit faster than revenue. So they have to spend a lot of money and almost grow it faster than their revenue to keep attracting clients. But so far it's been working because their revenue is doing pretty well. Okay, R&D spending, it's up, but doesn't look like it was as fast as revenue. General and admin is up, but nothing crazy there. Total loss from operations is $39 million from stock-based compensation. That's wrapped up into here and possibly in cost of revenue a little bit, depending on how it's allocated. It's not broken out separately on the income statement. You always find stock-based compensation on the statement of cash flows because it's an add back, that's the proper way to do it, unlike what Joseph Carlson thinks. But anyway, so they have a net loss from stock-based compensation, but it's a non-cash expense. Let's go to the statement of cash flows. Let's see what's going on there. This is tiny. This is annoying. Okay, so here's exactly it right here. Net loss of $156 million on the income statement, accrual basis of accounting, but they add back the non-cash stock-based compensation expense. The stock-based compensation is higher than the net loss. Okay, let's see if there's anything else crazy on here. Net accretion of discounts and amortization of premiums on available for sale securities. Deferred income, loss on extinguishment of debt. Wow. So apparently they lost, this is a one-time charge it looks like over the last 9 months. They lost $50 million paying off debt early. I guess they really just wanted to pay off that debt early. I don't know. Okay. Let's see. These are just changes in current assets and current liabilities. So you can almost look at these changes right here, and you could actually go to the balance sheet and see kind of how they calculate it. That's how it's done. But these are just changes in what's called working capital on the balance sheet. Up here is non-cash expenses and non-cash revenues. Down here is changes in current assets and current liabilities. But overall, they've massively increased their operating cash flow. I don't have any issues there. Okay, a big chunk of it was deferred revenue, which is revenue that was paid up front. Revenue, or not revenue, but it's sales that were paid up front that you haven't earned yet. So about half of their operating cash flow just came from upfront payments that they haven't earned yet. But still, very impressive growth. Let's see. PP&E, like I said, it's basically leveled off. They're not spending that much. They put a bunch of money in available for sale securities, probably to generate interest income. Let's go down to financing. Payments of senior convertible notes. This is the notes that they paid off, that $1.2 billion of debt. They're starting to chip away at that, including a loss on extinguishment. Okay. Let's see. Exercise of stock options. $11 million of cash generated from employees exercising stock options. And employee stock purchase plan. So you can see the dilution clearly right here. So it shows up as a positive cash flow from financing here, right? Great, wonderful. But it's an add back on the statement of cash flows. So you almost don't see the effects of stock-based compensation unless you know where to look and you understand the accrual basis of accounting. But it shows up here on the profit and loss. So what do I think about this company? I mean, it seems like a very solid company with good growth so far. But stocks like this scare the crap out of me because one thing goes wrong. The growth that everybody's projecting. And trust me, there's a lot of growth built into this, into the valuation, even now after it's crashed massive. Oh, but bro, it went down, bro. So it's going to go back up. One bad quarter, and this thing will get nuked from orbit, okay? So that's my thoughts. Typical tech company. Oh, strong revenue, strong profits, or strong cash flow, but horrible profits because of stock-based compensation. So I guess have fun being diluted and potentially getting absolutely nuked from orbit. But if you buy this, you could also be lucky and it could vertical line. I mean, that's just how the stock market works, man. I can't make a prediction like that. That's my thoughts on Cloudflare. It's the future, bro. Okay? Talk to you later. Cheers.